The hidden power of index funds: earn money while you sleep. Imagine this. You're sleeping peacefully at night while your money is quietly working behind the scenes, growing, earning, and multiplying. Sounds too good to be true? Not with index funds. So if you're tired of chasing stock tips, watching the markets daily, or stressing about picking the right company, keep watching. This strategy could change the way you look at money forever. What exactly are index funds? Let's begin with the basics. An index fund is a type of investment fund that's designed to follow or track a particular stock market index. But wait, what's an index? Think of an index as a list or collection of some of the biggest or most important companies in the stock market. For example, the S&P 500 is an index that includes 500 of the largest companies in the US. The NASDAQ 100 includes 100 top technology companies. There are also indices that track small businesses, global companies, or specific industries like healthcare or energy. When you invest in an index fund, you're not just investing in one company. You're putting your money into hundreds of companies at once, depending on the index. This gives you automatic diversification, meaning your money is spread out so you're not putting all your eggs in one basket. It's a simple and smart way to invest, especially if you don't have the time or interest to research individual stocks every day. How do index funds make you money? So how exactly does your money grow while you sleep? Index funds generate income in two main ways. 1. Capital appreciation. Over time, the value of the companies in the index tends to go up. As their stock prices rise, the value of your investment increases too. This is called capital appreciation, when the price of your investment becomes higher than what you paid for it. 2. Dividends. Many companies in the index pay out dividends, which are portions of their profits shared with investors. These dividends are collected by the fund and either sent to you as cash or reinvested automatically to buy more shares of the index fund. Both of these income sources work together to grow your wealth over time, and you don't need to lift a finger. The magic of passive income. Passive income means earning money without having to be actively involved every day. And that's what makes index funds so powerful. They are the perfect example of passive investing. Once you invest your money into an index fund, you can basically let it sit and grow. There's no need to check the market daily, worry about stock performance, or make constant buying and selling decisions. In fact, most successful investors recommend the buy and hold strategy. Put your money in, leave it there for years, and watch it grow. Why index funds are great for beginners? New to investing? That's okay. Index funds are one of the easiest and safest ways to start. Here's why. Simplicity. You don't need to research companies or follow stock news daily. Diversification. Your money is spread across many companies, reducing risk. Low fees. Most index funds have very low management fees because they don't require a team of experts making stock decisions every day. Consistent growth. Over the long term, the overall market tends to go up, even if individual companies go up and down. If you've been putting off investing because it feels too confusing, index funds offer a gentle entry point. Compound growth. The secret sauce. Want to know the real secret to long-term wealth? It's called compounding. Compounding is what happens when your earnings begin to earn even more earnings. Imagine you invest $1,000 and it grows by 10% to become $1,100. Next time, the 10% growth is on $100 instead of $1,000, which gives you more. And the cycle continues. Now add in reinvested dividends, and the snowball effect becomes even stronger. Think of compounding like planting a tree. At first it grows slowly, but as the roots get stronger, the branches grow wider, and soon it's a huge tree full of fruit. The longer you let it grow, the more fruitful it becomes. Long-term strategy beats short-term gains. A lot of people try to time the market. They buy when they think prices are low and sell when they're high. Sounds easy, right? Unfortunately, it's almost impossible to do consistently. Even professional investors get it wrong. That's why index funds focus on long-term growth. The idea is to invest regularly, whether the market is up or down, and stay invested for years. Over time, the market tends to recover and grow, making long-term investors the real winners. So instead of worrying about every market dip, be patient and let time and compounding do the heavy lifting. Diversification ensures safety. Let's say you invest all your money in one company. What if that company goes bankrupt or loses value? That's a big risk. Now imagine you invest in 500 companies at once. If one performs poorly, the others can make up for it. That's the power of diversification, and index funds give you that automatically. They help protect your money by spreading it across many sectors, industries, and companies. It's like having a safety net for your investments. Low fees, more money in your pocket. One of the biggest hidden benefits of index funds is their low cost. Actively managed funds, where managers pick and choose stocks, often charge high fees, sometimes over 1% of your investment each year. That may not sound like much, but over 20 or 30 years, it can add up to tens of thousands of dollars. Most index funds charge as little as 0.05% to 0.20%. That means more of your money stays invested and keeps growing. Always look at the expense ratio before choosing an index fund. The lower it is, the better it is for your long-term returns. Using index funds for your financial goals. Index funds aren't just for retirement. They can help you reach all kinds of financial goals. Saving for a home, building a college fund, starting a business in the future, or simply growing long-term wealth. How to get started with index funds? Step by step. Starting with index funds is easier than you think. Here's how. 1. Pick an index fund. Look for a fund that tracks a popular index like the S&P 500, Total Stock Market, or NASDAQ 100. Check the fees, performance history, and reputation of the fund provider, like Vanguard, Fidelity, or Schwab. 2. Open a brokerage account. Choose a reliable online brokerage. Most platforms are beginner-friendly and allow you to invest with as little as $10 to $100. 3. Set up automatic contributions. Decide how much you can afford to invest each month and set up auto deposits into your index fund. This builds your investment habit and ensures consistency. 4. Leave it alone. Don't panic during market drops. Stick to your strategy. Let time, growth, and compounding work their magic. What part of this strategy excites you the most? Let us know in the comments, and if you found this video helpful, don't forget to like, share, and subscribe for more financial tips and simple strategies to grow your money.